Welcome back, folks. This is a daily chart of the dollar index. Last week, the ideal scenario was to wait to see if we were going to get any kind of follow through after closing in this SIBI, sell side imbalance, buy side inefficiency. We have since taken this range in here, the single down close candle that creates that sell side imbalance, buy side inefficiency. In other words, all the singular movement down right in here, that's what we're looking for. And I'm going to highlight that single candle because it's going to make more sense once we drop down into a lower time frame. And you want to do this when you're studying also. So whenever you see a chart, a higher time frame chart, or any chart really that you can reduce to a smaller time frame. In this case, we have a daily chart. So we have one single big range candle that creates a SIBI, sell side imbalance, buy side inefficiency. Where does that inefficiency begin? And where will the buy side imbalance be balanced? Okay, well, we're going to look at that now. Before we consider the lower time frame study of this down close candle, I want to take you to this range up here as well. If we trade through this and keep on pressing higher into it, this is that line in the sand. This is a volume imbalance. There's a missing portion of price data in here in the form of a body, okay, a candle's body. Think of it like this here. Okay, we have this gap. We created basically a filling effect with the bodies. Go back over here, essentially fills that in. We have, well, just like we have here as well, price comes down and gives it a full candle between these two price ranges, the close and the open. So there's a gap in there. Even though we saw it wick here and open, that gap exists from the close to the open. Why am I not talking about the low? Because the low is insignificant, so minor. I would rather use the open. In here, what constitutes the end or the closing of this imbalance? Well, prior to this down move, we want to look for the last known buy side delivery. That's going to be this up close candle here. Now, this candle, and I'll show you the low on the up close candle here first. So the up close candle's low is 96.47. The next candle here's low is 96.45. So we had sell side delivery 2 more pips below this up close candle. So that's the marker that we have to use when we're looking at this down close candle. So once this candle closes, okay, it creates that full big large down close candle. Our eye goes to the last up close candle where buy side was offered, and then we go to the right until we get to the candle that creates the imbalance. If there's any downside delivery, okay, of price where it offers sell side, the open is here. It trades down below the previous up close candle by 2 pips. You mark it right there on that low. Why? Because price has already offered it again from the open through all the body. Sell side has been offered efficiently from the previous day's low and this candle's body. So you extend that out in time, which is what we have here. The buy side imbalance has been effectively completed up to this price point here. This candle's high on last Friday at 96.27. Okay, so between 96.27 and 96.45, there is a sell side imbalance, buy side inefficiency. Since we have a vertical line right in here, what we're going to be doing is dropping down into an hourly chart, and you want to toggle this right here and this if you have any kind of staggering or creates an extra space. I like to always have a space here so I can kind of like envision what the candles may do. If it's blunted like that, I don't like it so much. It looks too crunched up. But again, it's not necessary. But this one here, you want to make sure that you're toggled on that. So when you drop down to a lower time frame, it gives you the data where you don't have to keep scrubbing through. And you've seen my videos where I put you through that, looking for the part of which I wanted to see where we were going to talk about. All right, so this is that vertical candle where that day begins, and all of this imbalance right in here, and here's where it completes the buy side. So all of this remains exposed, okay, or imbalanced on the sell side. No other candle to this price point here, back to it, no candle went higher than this one. So all of this sell side delivery, which is an imbalance because it's all sell side, all elongated to the downside. No upside was offered until here. So prior to this high here, this high, the balance has been completed on the upside. In other words, sell side has been rebalanced to this price point. And I guess it'd be easier if I did this. Okay, so we have a different color here. So from this point here, all through here, and we'll just take this off for a second because it's going to confuse you. The sell side imbalance here completes buy side delivery or buy side rebalancing to this price point here until we get to here. Now we went slightly higher. So the range on that sell side imbalance is now still from here to here. So all this range needs to be delivered on the upside. The next portion of price action, we see it price trades right up to here. So now that range of imbalance on the sell side has now been rebalanced to this price point, leaving only this portion. When price trades up, it goes right up into the imbalance. It's been rebalanced. Price comes back down. Where does it go back down into? It dips down into an order block, yes, but it's working inside of a previous area where it has rebalanced. Every time there's a new point of rebalancing, they're going to be influential in terms of future price action. Remember what I taught you regarding the Sunday gap. That gap can act as support and resistance because it's fair value. So if it ever returns back to it, especially if it's a gap that we talked about when the market is predisposed to go lower and it gaps lower, but then trades above that opening gap on Sunday and trades back down into it as support, many times it can act as a nice buying point, especially if it overlaps with a kill zone. Well, these price points, when we rebalance, they are also markers in IPTA where it will remember them itself. So price will be responsive around it. We're seeing responsiveness to it here. Yes, it's an order block, but more specifically, it's a point of rebalance. So when we have rebalancing, you always want to make notations on your chart when we have imbalances like the sell side imbalance. Every time price finds a new point of rebalancing, and what do I mean by that? This entire range, this single down close candle, is sell side imbalance. Buy side has to be offered. So we're waiting to see how far we'll go up into it. Perfect delivery will take us right back up to here, which obviously you see it do that. But buy side delivery here stops and it starts to move away from it. So it creates a range or a new range of imbalance from this candle's high through all the way up to here. Then we have a slightly higher one here. Notice what's going on. Every time we create a new price point, and please folks, look, I know there's a lot of people right now, they're all jammed up in chat rooms and sharing my stuff, but I'm getting to the point where I really don't want to deliver anything new and just refine what I've already done because it's being abused very badly. And if you haven't been part of the group officially, you don't have any right learning this stuff. And if you have offense to that, that's your problem. But look at the sensitivity in price right here. We trade through it, so this one no longer can be used as a measure of support, right? Because we only poked through it and came away. So now we have to use this higher point of rebalancing right here. So let me put little arrows on it so that way you guys can see what I'm talking about. This one I'm still doing payments today. So if you have not had your processed to continuation to the next month, I will get to you. It's only a couple hundred more I got to get through today, but I'll do that before I hit the bed. Usually I don't work past 5 o'clock, but there's a lot of you that have helped me get the payments in before the first of the month, and I appreciate that. So, but I'm just letting you know I will be stopping at 8 o'clock. So 8 o'clock I won't be doing anything more my local time, and I'll just resume again 5 a.m. tomorrow with continuation in payments. So now this area here that's been rebalanced, the range of imbalance, remember this isn't here yet. This line's not here yet because it hasn't created this higher high yet. So the balance point of buy-side delivery is here. All of this still has to be in an efficient market rebalanced to the upside. So price has to go up through this range between this high and this area over here. Once it trades up, then IPTA has officially rebalanced that price range. Why does it need to do that? It needs to do that to be efficient because all of the price levels between 96.45 to essentially 96.10, all of those price points did not get offered for buyers. So even though price was offered on the downside and it quickly dropped, efficiently delivered price will offer both buyers and sellers an efficient means of pricing. Because IPTA drops so quickly like that, it knows it has to go back up there to offer an efficient market condition or efficient market price. So this high here is a new rebalancing point relative to this range. Now, again, I mentioned that in April's content, it's going to be decisively different in terms of what you need to do to study. It's not going to be, here's a breaker, there's an order block, and there it is. There's going to be some thinking involved. Okay, and this is where we have to start thinking algorithmically, not just core content, just basic ICT content and ideas. You're going to be having to think about how price will have to revisit specific delimiters. Now, delimiter is going to be what we're talking about here. This is one where price has been offered buy side, but then we see it trade up to it here, but then trades through it and then comes back into it. So in here, we're finding some support relative to this one, but this one is the new rebalancing point relative to this imbalance here. So extend that out in time, you can see price uses this level as a means of fair value. Why? Because it's rebalanced an area that is inefficient. I don't care, and you shouldn't care so much about what price is doing below it. That's insignificant. What we're looking for is when is it going to go above this high, and now once it creates this high here, we have a new rebalanced price range, which is here. So this range here is remaining open. So sell side imbalance between these price points here remains still. But this old high is important. It's significant. Why is it significant? Because it creates a measurement of rebalancing, just like this one will. We see responsiveness here when price trades down to that one. And I just want to add one more line here just to show you contrast. Right there. And you can see how price trades not through this high yet, but comes back down into it, finds support, and it's also order block. 2 down close candle. This is for your notes. Pay attention. Order blocks that are around fair value theory. That could be in the form of a fair value gap. It could be in the form of equilibrium or a volume imbalance where there's a chunk of data missing for a body, just only wicks exist, or there's no price data between 2 candles. Those are fair value reference points or fair value theory. Order blocks that are in close proximity to that are going to be order blocks that are high probability. Now, if you didn't catch that, just rewind the video several times, then go back through your price data And you'll see what I mean by finding high probability order blocks. And the same thing is said for both bullish and bearish order blocks. So price trades down into it here, and we have some expansion on the upside, and then perfect delivery closing in the range. So I want you to understand what defines the beginning and the end of an imbalance and an inefficiency, and when it is rebalanced. Each time it does that in stages, okay, it doesn't always do this. This one's not one because we have this initial rebalance point here. Anything lower than that is not important. We have a slightly higher high here. But you can see how these price points eventually will be revisited. Now, for those that have a disbelief about IPTA or an algorithm controlling price, the argument that I would pose to you is, why does price respond to these specific price points so sensitively? And it does it on all asset classes, on all time frames. So as a computer programmer, I learned that we had to be able to plug in source data. Okay, so in other words, a program is a list of instructions to do computations, compress and compile data, and put out some kind of a report or some kind of a calculation or a presentation. For instance, if you were doing a computer program for payroll numbers for a company, okay, you're a computer programmer that does the payroll program. The payroll program that generates all the people's paychecks for each pay period, these programs have to have your hours worked, your vacation hours, the hours that you didn't work, and then it has to have the computations to do your local area, state, and federal tax, okay, or if you have taxes in other countries, however that's structured, I don't know. But it has to have your numbers, your data. The way IPTA pulls data and creates different arrays, okay, and that's why when we talk about things like in month 5, PD arrays, that's why they're called PD arrays, okay? They're arrays because they're known areas of which IPTA or the algorithm will be able to return back to and pull that data, that specific price point relative to the time, the date, the day of the week, and its specific price level. What makes certain price levels more significant than others is what I'm showing you here. Whenever there's an imbalance, we need displacement. Okay, displacement causes IPTA to go right to very specific price points, and those specific price points is what I showed you here. So no one should have any misunderstanding about what is an imbalance, where does the imbalance begin, where does it end, how does it complete, and why is it information that's useful? Because it's not so much that it refills or completes and rebalances. There are new points of understanding that I just gave you tonight that are completely outside the scope of anything else. No Chris Laurie stuff, no Sam Seiden, no supply and demand stuff, no order book theory, no volume analysis, no VSA, no ladders, no DOMs, no volume profile, none of that stuff. None of that stuff is what I just explained to you. None of it. Because I'm talking from an algorithmic standpoint. Because this is how I'm able to do what you see me doing. And it's the same stuff all the time. And I just don't tell you what I'm looking at in the free tutorials. Here, I'm explaining down to the minute detail of what it is that I'm looking for. When we look at S&P, like I did today in the New York session, explaining how to frame New York setups, I'll go a little bit more in detail on what I just showed you here. But for now, I just gave you $1 million concept and depth of understanding that, listen, I know there's hundreds of you in here that are doing something that I've asked you not to do. Share, putting videos out, doing all kinds of stuff. Remember, you don't know everything. And if you piss me off, I'll draw a line where I'm complete with giving all the content that I'm comfortable with giving, and it's done. You'll have to determine whether or not if I know anything more or not. As far as I'm concerned, I could stop right now, give the last couple price action models, and then refine each one of them to a trading plan, and done. And then just do weekly reviews after that for as long as I want to do them. I don't want to do that And I'm not trying to threaten you. I'm promising you. If you're in here doing that, you are going to be the contributing factor to me saying, you know what? I'm always going to do weekly analysis. That's always going to happen. But the depth of what I'm willing to teach, guess what? That well will dry. Take it to heart. So moving on over to euro dollar. Euro, we talked about last week, how we ran high up here. That was our target. We moved away from that. This area in here, same thing. We have an imbalance. This is a busy buy-side imbalance, sell-side inefficiency. What makes it like that? We talked about it for the candles. These levels, we draw them out in time. Right now, we are still inside of a consolidation profile. Same thing with the dollar index. We're essentially still inside of a consolidation. Near-term liquidity profile is these equal highs up here. We'll look to see if those get rated. And then obviously beyond that is that area on the daily chart I mentioned over here. So this is the point of interest for me. From an intermediate term level, like I said, I'm bearish still on dollar unless we go through this on a closing basis. Now, we can trade up to it and then sell off. Great. And it still fits my intermediate term lower dollar index. But nothing needs to happen. Remember, we're in a market condition that every asset class, every one of them, is compressing. They're consolidating. There's no real displacement. There's no real movement, and volatility is shrinking. Okay, so while it is very, very frustrating, a couple of years back we had situations like this, and all of a sudden volatility came in like a lion, and it was wonderful. You know, the salad days came back to trading. It means big ranges, big sustained price moves. Everything was great. It was easy money. Easy money. We are not in easy money right now. Okay, we have to work our tails off to get to where the opportunities are very, very low risk and high probability and high yielding. So that's why day trading, that's why I teach it. And that's why I settled in it, because I can use day trading for longer term, short term, intermediate term, scalps, one shot, one kill. I can use all of that for whatever model I want to use in. But if you're turned off completely to day trading, you're kind of screwed right now, because there really isn't a whole lot of swing trades to take place. They're not forming rather frequently, and they're being rather fickle. That means that they're not as clean, not as symmetrical as we would like to see them, or at least as I would like to see them. Doesn't mean there's opportunities. There's opportunities here, yes. There's plenty of them. But you just got to be more nimble than you normally would in a more volatile market. All right, so let's go back over here to euro dollar. So the levels here I have noted, they're all daily highs. Daily high, daily high. We have a single pass candle where it runs from this candle's high to this candle's high. We have this one single candle here. The next candle we open, we trade down. So we left this little portion of price data. And I mentioned this the last video, whatever one it was, I can't recall. I lost my train of thought. Last week's week review. So for this week's analysis. And go back and look at that, and you'll see that. But I'm just going to basically draw the lines on the highs. And we'll do the same thing we did for the dollar index. So we have this single candle here, and you'll see this low and that imbalance in here. That'll be targeted. So again, everything's toggled as it should be. Drop down into an hourly chart, scrunch it up. Don't want to use that now. And we're going to scrub back to the vertical line in here. All of this area here is not as clear on a lower time frame as it is on a daily chart. You need to have the dividers on. So this day here is a Monday. So Monday's data is what we're looking for. Notice again, if we go back to the daily chart, That's this candle right in here. What we're looking at is the difference between this candle's low, 112.48, and this candle's high, 112.45. So it's only 3 pips, but those 3 pips used in the right context will act like a magnet. Price will want to do what? Go return down into that because it needs to offer that value. What value is that? Fair value in the form of sell side delivery, because it moved up through it but didn't come quite that down to it here on this candle. We ran higher to run the liquidity here. So where does the IPTA need to go? It looks back in its data to see where these gaps are. Now, I'm not going to sit here and try to explain to you how a computer program finds that data, sifts through it, and compiles it and determines that's what it needs to do. Just trust me, anyone that's ever studied programming, you know exactly what I'm talking about. It needs to be able to go back to these reference points, okay? And it's as simple as that. It's complex, I know, but that's as simple as I can make it so you understand. Just know that these gaps or these inefficiencies, they are remembered. Let's say it that way. I'll try to put it in terms like that. The computer program or the algorithm that price operates on remembers where inefficiencies are. Now, we're taught that price comes down here because of sellers. That's not what's going on. Okay, that's not what's going on. Because if that was the case, short selling and buyers would take the markets well beyond the scope of what we see it do. Believe me, it's always controlled. It's always scripted. Price is going to go down to this price point here. Now, knowing that, let's go back into the hourly chart. Okay, so that's that Monday in here. The gap between the 45 and 48 level well, I actually have it on the chart already. That's this little gray area here. So between the maroon colored line and this gray colored line, that's all we're looking for downside draw on liquidity. Price trades into it here, midway, responds. Trades down into it, and look at the time it spends in here, rebalancing. Okay, IPTA has now, in its own calculations, has now removed the necessity for this price level. So now what can happen? Displacement. The market can trade higher or the market can trade lower aggressively away from it because it has rebalanced. That's why it's important to understand points of rebalancing and imbalance. Imbalances that are left open, they're targets or trade setups if they're large enough. If they're small, they're targets, okay, where price may reach up to or reach down into. In this case, we see it trying to trade down into it. Now, some of you, they're looking at this, are going to say, well, wait a minute, it's not so important because look, we had it wick through it here, we had it wick through here, we had it wick through here. Yes, you're always going to have that. And everybody's price data on these specific candles here, if you look at the lows on them, they're all going to be different. That's what the brokerage firms are allowed to do. To some degree, there's going to be a discrepancy, and you sign your paperwork when you sign up to join them as a brokerage firm, even if it's demo, you're acknowledging that they are free to do that. They have an allowed range that they're taking great liberty of using against you in terms of your spreads. That's what's always occurring. So whenever you look at order blocks, whenever you look at fair value gaps or liquidity voids, they're always going to be slightly different. Okay, many times grossly different, because that's where all of the liquidity-based draws are going to occur. That's what makes price pull higher or lower. The price engines, that is the algorithm, they're going to those price levels, but they're going to those price levels from an interbank price level or pricing. In other words, say for instance, at that price level, it's 12.48. Well, interbank actually may be 12.40. It may be 12.42. There's a discrepancy there, isn't it? It doesn't quite get down there that far, okay? Or it may go lower. It's not a matter of not reaching it or going through it. It's just there's going to always be some measure of discrepancy, and that's that gray area we have to be comfortable operating in. If it makes you uncomfortable that it doesn't have this always, then trading's not going to be for you, okay? Just know that targets are rough ideas, entries are highly specific, and we're okay with having a little bit of drawdown against us because we're getting in so close to the pools of liquidity or imbalance and rebalance that it's insignificant and inconsequential to our total outcome or result that we're looking for our trade idea. Targets, we have to be flexible with because everyone's going to take an exit profitably at different places all the time. And scaling out, we're looking for specific price points, and I'll talk about that again when we get into the S&P. But in here, we have this area up here bothers me, I'm going to be honest with you, because we have this imbalance. We did trade up into, what do we got here? Scrunches up. So here's Friday's trading. We have a little bit of a imbalance that was created right there. Right there. So this candle's low. Why that low, Michael? Why not the order block? Yeah, you can use that. I'm just looking at where the low is, where market structure broke to the downside. So this is pure sell side imbalance. This is sell side imbalance, yes, but it's part of this range. Okay, so the more sensitive price point is up to this level here. And then if we trade through that, then I would consider, and this is important, if we trade through that, then I would look at this last up close candle as a target for upside delivery because of it being a bearish order block. But you can't look at that yet until we do something with this level. Okay, but more specifically, this low to this high on last Friday. So Thursday's daily low and Friday's short-term high here in the London Open crossover, getting ready to go into New York Open. This high, the midpoint of that, okay, is exactly where we hit, bang, right there. So there's consequent encroachment. Again, I mentioned that in passing the last couple weeks. That is a institutional order flow entry drill candidate. So you could be a seller there. Why be a seller there? Remember, you're looking for that imbalance on the daily chart on the dollar. So that means we have a soft upside bias. And what do I mean by that? Even though that seasonal tendency and the likelihood that the dollar index may want to go lower, short term, very, very, very short term, our objective was to anticipate higher movement on the dollar index to rebalance. If that happens, that means that we're going to be short-term bearish on foreign currency. Well, that's what you get right here. Okay, price drops off and in here. So the current condition right now, I don't like the way they left these highs, and we still have a little bit of a range up here. So to me, I don't know. I'm just going to say it like that. And that was the reason why I left Forex alone today. I didn't want to trade Forex because it doesn't make sense, and I don't want to rush in and go against the dollar index because I'm aware that I could be wrong in here. Even though this could be a rebalance and then we can go lower, we're still in this large trading range. And I mentioned how we could potentially stay in this range. So when I have those communications with you when we do our weekly reviews or our midweek reviews on Wednesday like this one is, when I talk about things like, and we can stay in an area, we can stay in that range. Whenever you hear that, okay, it's like a red alert that I am only really interested in scalps and day trades, because the experience factor that I'm using when I'm talking to you is telling me that we're not likely to have a sustained large move, higher or lower. So if that's the case, what profile are we in? We're in consolidation. So consolidation is a scalper or day trader's model. It's going to thrive in that. Not swing trading, not position trading, none of those things are going to be advantageous, at least from my stance as an analyst. So if I'm looking at price, I'm looking at it from the scope of profiles. And because we're in a rather large consolidation with no real indication that it wants to go one direction over the other, I cannot sit with you like you've seen me in many instances over the last 2.5 years now. If I see something that has a very strong indication that it wants to go one way or the other, you hear it in my voice, you hear it in my delivery. I'm telling you specifically, this is what's going to happen. And it usually happens. When I say that we're going to most likely stay in a range, right away, scalp, day trade, that's all you try to do. Okay, and then if you do that, you're going to find that you're going to be a far less frustrated student and demo trader than if you ignore me and try to find out on your own. Okay, so in short, I don't know right now. And I have mentioned this in the past, and if you're new, it probably doesn't sound comfortable hearing me say I don't know, but there's a few times where I'm honest with you and I just simply don't know. That means I have to wait for more information, just like you would. So if you look into the charts, we're not in a position where we have to find a trade. That's something that you got to get in your head. Just because you're in front of the charts doesn't mean, well, here's the contest, here's the challenge. Michael, you need to find a trade right now, and you need to do it in the New York session today. Go. That's not how it works. So if you think that way, then you're probably very emotional, and you probably feel emotional even in your demo wins and losses because you're putting way too much emphasis on your participation when it's not required all the time. You want to have choice, high quality setups, and that's going to come by understanding market profiling. Now, obviously, I have a lot of experience and I do certain things because I understand what profile I'm in and how I can internalize what the algorithms are going to do. You don't have that yet. And there's no reason for you to be upset or, oh, you're holding back. No, I'm not holding back. I'm telling you, it's an experience factor that you're going to have to grow into. I can teach you and teach you and teach you, but you still have to practice and use them. Think about it before you got on the bike the first time. You want to ride a bicycle? Great. Okay, if I tell you you've never got on the bike before, but if I sat down with you and said, okay, what you need to do is you got to go walk over there, grab it, sit down on it, and just keep pedaling and balance yourself. Now, you're going to get on that bike and not fall? Of course, you're going to fall all the time. You're going to skin your elbows, skin your knees, and it's going to hurt. And if you're weak at heart, you're going to probably fall off that bike and say, you know what, I need daddy to hold the seat for me. And then you work up to that. Well, I'm being daddy, okay? I'm telling you how to train yourself effectively. That means if I'm telling you that we're most likely in a consolidation, even if you don't like day trading, even if you don't want to be a scalper, study price action after work, or if you're able to do it watching it live. In that context, that's how you're supposed to be using your time, okay? Do your institutional order flow entry drills based on those ideas and premise, short-term scalping, and you're going to find that it will help you understand what price is doing. And then when we get into easier market profiles where it's trending, okay, and we have expansion models to the upside and downside, then you'll be able to capture bigger moves and be able to move from scalping and day trading to swing trade and position trading. But you can't squeeze blood out of a turnip. And some of you are asking me to do that when it's just impossible. I can't make the dollar go outside of this range. You can't either. So because I know that we're probably going to stay in this range, we have to work within this range. And that means it's going to be sometimes very frustrating for you as a student hearing me tell you we have to wait. And what do I mean by that? When I say I don't know, that means I'm sitting on my hands. I'm going to look outside of this asset class and do something else, which is what I did today in the S&P. But let's talk about cable real quick. It's not too much to talk about, but here's the British pound versus the dollar index. This is the daily chart. You can see I mentioned this. Just stay away from it. It's ugly. I have no idea what it wants to do, and I still don't know what it wants to do. There's a Parliament vote that's supposed to be this Friday, as we mentioned last week in the calendar, economic calendar portion of our video. I saw a tweet saying something that May is something about stepping down before the next vote or whatever. I'm not sure what that's all about. If you guys over there across the pond want to fill me in on Twitter, what you know about what's going on relative to that, I'd be appreciated. But again, I just don't understand how it's going to impact this pair. So I'm respecting it, and I'm also trying to protect you as well. Don't touch it. So let's go into a hourly chart. You can see we had a New York close kill zone in here between 3 o'clock and 5 o'clock New York time. If you watch that, it's going to give you sometimes where these moves will sneak in. There was a FOMC speaker due at 5:30 today, and I don't know what the catalyst was fundamentally about this here. It just ran above old high, and then we broke down. We do have these equal lows in here. At the time of me starting this recording, I did want to talk about this, but I've jawboned a little bit much, and you really couldn't have taken advantage of it because it's still being produced, and you'd have to compile it and then upload it, and by the time you're watching it at this point in the video, it's already swept the lows. So, again, that's also something that you guys are, it's the new folks. You're emailing me, asking me, can you vet my trade? Is this a good trade? Is my stop in the right spot? You're cheating yourself because I'm not going to be the answer oracle for you. I'm not going to tell you what to get into and get in and out of in your trades. You got yourself into them. If you're having a problem, the easiest way to do it is get out of it. And that means you may have to take a loss. And that's fine. You're going to take many losses in your career. But if you're bothered and you need to ask me about what you should do about the trade right away, that's your indication that you got to get out of it. Okay? You don't know what you're doing. Stop the bleeding. But don't send me time-sensitive emails because it takes many times over a week in the volume I have getting with the new students. I'm getting a lot of emails now, more than I was before. So it takes time for me to get to you all. I get to you, but just sometimes it's probably not in the most timely fashion for your liking. But I have to be fair and take them in the order I get them. So looking at this, it'll be interesting to see how much we move beyond this. We have equal lows in here. Obviously, you want to do scales of 10, 20, and 30 pips, or you can do what we talked about before, 5, 15, and 25. We can do it like that. It's completely and up to you what you want to do. As a tip also, when can I move from using 10s, 20s, and 30s to 5s, 15s, and 25s? If you do your scaling below these lows like this, and if it lines up using 5, 15, and 25, it lines up with like a gap over here, chances are that's probably what they're going to use. Okay, if it remembers this fair value gap in here, what's the gap? This candle's high, this candle's low, only buy side delivery here. So to rebalance, it's going to want to come back down into here. That makes this a significant downside objective for a bullish order block. It does not mean it's a buy. This means that's the target where price may reach down into. Ooh, think about that. I just gave you a whole lot. Trust me, if you didn't catch it, rewind the video and listen to it again. But I would not touch cable where we're at. Just know that I don't trust it. I don't know what it wants to do. And because I don't know what it wants to do, I am not getting near this thing. Because I know I'm going to lose. And if I know I'm going to lose, why are you going to touch it? So again, it's not an arm wrestling match, folks. Moving on over and completing this video here, the S&P. Today I gave you guys an example of trading the breakers. And I'm going to go into a 4-hour chart before we do anything else. We have a 4-hour here. And I'm already over my time. I said I'd have the video to you at 7 o'clock, but it's now 7 o'clock, my local time. But I apologize. You'll have to excuse me because we're in payment season. So the last week and a half and the first week and a half of every month, I have a lot of work. It's a lot of work. And even with my help, it's very daunting. So I appreciate your patience. So we have this breaker here. What is it breaking? It's breaking the liquidity around the shorts from this high. So short sellers in here, they get rated, they're knocked out. So once we trade below the last down close candles prior to that run up, that's in here. Okay. So now we can drop down into an hourly chart, and that shaded area gives us context of, okay, we're inside of a breaker. So inside this breaker, what are we looking for? Well, there's other breakers in here, smaller breakers. We have one that is here. Do you see it? No, you don't. Not on an hourly chart. When we drop down to a 15-minute time frame, it's going to jump off at the chart. Now we have this swing high here. This swing high, think anyone that was short from up here or here, where's their stop loss going to be? If they haven't moved it, it's going to be right above this high, at or just at that high. So this run up, my eye goes right into here, these two down closed candles. So what I was showing, and it's probably real quick if you watch that YouTube video again, you can actually see me map out real quick. I mean, it was happening. I just literally looked at the S&P chart while I was doing payments today because I needed to do something for New York, and I didn't want to touch the Forex pairs because they're crap right now, and I don't want to touch it because of the dollar index. So I said, okay, I'll just trade S&P. I know S&P really well. If S&P set up something, I know I can engage with it, and there it is. So incidentally, I mentioned on Twitter also today that I'm going to be doing a little bit more focus on Forex later on, a week or two. So any examples I show is going to be really relative to the S&P and or some other commodity, maybe like crude oil or something like that, gold. All right, so I'm not asking for suggestions. Okay, so I don't want anyone thinking they can say, hey, trade this, that, and the other thing, because I'm going to invariably upset someone if I don't do what you asked me to do, or you're going to think I'm ignoring you. I'm just going to do what I want to do. Okay, so just give me the flexibility to do that. I promise you'll learn something. So in the greater context of this shaded gray area, that's that 4-hour bearish breaker. Now we have a smaller fractal of that same thing. This is a 15-minute breaker inside of a 4-hour breaker. So now we're using fractal theory. Larger price pattern reduced to a smaller time frame repeats itself. In here, when price was dropping down, I already knew I missed the best case scenario entries up here. Is it chasing price here? No. Why? Because I'm inside of what will already be something significant in terms of bearishness. Price trades down. Okay? Trades down. I already know that the likelihood is they're going to work lower because we're inside of a larger 4-hour breaker. So that larger time frame has dominance. Okay? And the lower time frames are going to be subordinate to that. What does that mean? The lower time frames are going to move in the direction that is set and attributed to by the higher time frame chart. So if we're going to arm wrestle a 15-minute time frame versus a 4-hour time frame, the data or analysis or perception of price relative to a 4-hour chart is going to supersede and be parental to a lower time frame 15-minute chart. So this is subordinate to a 4-hour analysis. That's why I was going short here. I knew I wanted to get in here because I don't want to wait for it to come back up into it like it did here, because that's where my second entry was. Again, look down here. These are the areas where you can see my data, where I entered and where I took partials. So in the second entry, I knew I was going to want to put another portion in, but I needed to get something in at a higher price. Because why? I want a better price, right? I mean, you know it's likely going to go lower. I couldn't get in up here, so as price was dropping, it's still good. It's still good here. I could have shorted right there. Now, anybody else, oh, that's a crap fill. Is it really? Because it's right at where it's going to retrade to. That's what this is. This is a retrade. That's all I did was you just retrade entry on a breaker for the second one. So that second entry is just a retrade. So price opens here, trades up into it, breaker, and you see me annotate the chart as I was doing the recording. Price expands away, and let's scrunch this up a little bit. Here is Tuesday's lows. I want to take profit below previous day's low. So if we're looking at, this is the portion we're talking about for framing New York setups. Take notes. If we're looking at a bias, obviously the bias is down, okay, because we're trading at a 4-hour breaker. We're also forming a lower 15-minute time frame breaker. I want to be trading in the lower end of before the breakout happens. I want to be in there before it gets outside of it. If it goes outside of it like it does here, in the video you watch me wait until it comes right back up and hits the breaker. That's this candle right here. There's my entry there. Price comes down look where I'm taking partial profits. I said I was going to take 8 off below this low. What is significant about that? It's a previous day's low. There's going to be liquidity resting below here. Now, here's what could have happened. It could have traded down, and I could have took my partials, and then it could have came back up and stopped me out. And that would have been fine because I executed on my plan. When you look at New York setups, you always have to consider where the next point of liquidity is because that's what you're aiming for, okay? Since I'm bearish, I'm looking for a previous day's low because below previous day's low, there's going to be an enormous amount of liquidity, especially for something like the S&P. And we had equal lows here. Now, in the video, you only see me talking about the single low here. But you have the equal lows here with a shallow run below it. They're going to come back down below that, obviously. We have a little bit of an imbalance here as well. So an imbalance, equal lows, shallow run below these equal lows, that's not enough. And we have a breaker here. The context is we have so many things expecting this thing to go lower, but even though that's the case, New York setups, you want to be looking for previous day's lows if we're short, or looking to be short, and above previous day's highs if we're long or looking to be long, because there's going to be liquidity resting above that or below that relative to what I just mentioned. In here, we have a volume imbalance. What's the volume imbalance? Volume imbalance is where there's data. Yes, you see the, let me get this off here. You see that it wicked down through. So yes, there isn't a gap in the sense that anybody else would call it a gap, but there is a volume imbalance there. What do I mean by that? There hasn't been enough trading. It's only been a really thin wick down there to close that up, but that's not enough for us. We want to see price fill that in. Okay, so we want to see bodies come down into that. And that was really hardy. It does that in here. You see me take partials below that. Why? Because this could have been enough, and they could still keep these equal lows in here. I used that as a PD array. This is a PD array, a discount array. Because we're up here selling at a premium. Why is it a premium? Because we're way above fair value. Where's fair value? Below these equal lows, and this volume imbalance, and below these equal lows down here. So as we get to each one of them, I'm scaling off at logical levels that is not taught in free tutorials. So I do not want you talking about it in your tweets to me, okay, or in chat rooms, or in your blog, okay, or your YouTube videos. I appreciate and I love the fact that you love what I'm teaching you, but don't love it so much you're trying to imitate me. It really irritates me. And it's also very disrespectful because you're getting my life's work and you're trying to take credit for something that you didn't create or author. So if we have the understanding of what price is doing in here, once price traded below this gap here, all this inefficiency or volume imbalance. Now again, volume imbalance is an area where there is no bodies, just wicks, or a missing portion of like a gap. If we have that, it is a target, okay? It's a magnet, a draw on liquidity. It can come down to that, okay? And then think of it like a Sunday gap. Remember when I taught you about the Sunday gap? If we gap down and we come back up and fill the gap, it should sell off, right? Because it's whiplash, filling the gap on Sunday's opening. And then catapult is after the gap fills, it moves in the direction of the gap's opening, okay? If we trade above the gap's down, and then we're bearish, that gap now can act as support. And specifically, be very sensitive around the midpoint of that gap, which is consequent encroachment. Right in here, okay, split this range in half, and that's here. I'm just going to eyeball it. It's good enough for government work. Price trades back above the gap, okay, back above the high end of the gap, right here. It trades above that, and then what happens? It comes back down. What's it doing? Finding fair value. What's fair value? This over here. We rebalanced this price point, right? When we did this movement down here, didn't we rebalance that? No, we did not. We did not do that. Price sold off, yes. Downside delivery was offered. Remember, We're getting into the nuts and bolts of all this stuff. You're going to have to think now. In this range that creates this volume imbalance, in here, sell side is offered. Yes, it doesn't want a single wick here, but it's missing bodies here. This is just real sloppy delivery on price. So price comes down and offers it on sell side. This creates a pseudo imbalance for a SIBI, sell side imbalance, buy side inefficiency. The rabbit hole gets deeper and deeper, doesn't it? So now we have a sell side imbalance inside of a volume imbalance. What does price have to do now? It has to come back up. It has to come back up in here. Why? Because sell side's been offered, now it's got to offer buy side. That's why my stop loss was put right below there. That's why my stop was sitting right there. Because my eye, which I drew no special attention to in the video, was below this. Because I knew if it traded back up to this price point, it's going to do what? It's going to want to do the rebalancing of the sell side imbalance to buy side delivery here. Now, once it does this, this area, this range now has been balanced. So we have downside delivery, upside delivery, or sell side delivery, followed by buy side delivery. Now, this is a balanced price range because we saw both price offered on the upside and downside, or downside first and then upside. When we have a balanced price range, remember what I gave you last week. A balanced price range is now an area where equilibrium becomes a significant factor. Price trades to equilibrium, but to get to that price, you got to go a little bit lower, right? That's what happens here. They pick up more orders, and then and only then, we see a surge in price on SPOOs. What does it trade up into? The breaker, the imbalance, and here, all of this movement lower, breaking below these lows, price trades up into that. And then we gave up the ghost a little bit in here. Traded up into this area, or traded rather down into this area. We have a small little imbalance, buy side, imbalance, sell side inefficiency. We have now opened up and started trading inside that area right there and below equal lows. So it'll be interesting what happens. But draw on liquidity still is below this area of equal lows. And that's essentially, let me zoom in a little bit more. You can essentially see everything I just gave you here, and I'll drop down into a 5-minute chart. You can see all of those price points here below Tuesday's lows, down into approaching the gap. So I'm going to get in there ahead of the gap, below the gap, and stop just before the gap would start to be filled in. And you see me get stopped out here. And then obviously it does all this business later on. Back to a price point of rebalance. So now, when we look at New York setups, all of your targets have to be set around the understanding of previous day's highs and lows. So New York setups are generally hunting previous day's highs and lows, or if there's an extended range, in other words, what do I mean by that? Let's go back up to the 15-minute time frame. Say that Tuesday's lows were lower than this. Okay, say we were higher up, not lower like we were here on Wednesday. Wednesday's trading was lower than Tuesday's. Tuesday's had a higher high. So trading below here, yes, it's going to be significant pools of liquidity below Tuesday's lows, and it could consolidate. It's better if Wednesday was higher than Tuesday when we set this up, but it was lower. So we want to be mindful that yes, this could still be a swing point on the daily chart because Monday's trading is here. Monday's high, Tuesday's higher high, Wednesday's lower high, and now we're starting to break down. So this could be the beginning of a rollover and targeting Monday's lows and have a more significant downside move on SPOOs. And if that does that, we have this area to worry about because now we have all of this inefficiency in here. So where could it go? It can go here. Fill that in. Down to here. Right there. I like this range. And in here as well. we can fill in this space between these two little, my eyes aren't what they used to be, folks. Buy side imbalance, sell side inefficiency here, and also here. Between this one and here, this is a void. It's an extended fair value gap. That's what a void is. And again, it's not Chris Lorry's invention. Okay, there's always been an understanding of price vacuums, and this is what this is, a price vacuum. And I think that's going to be it, folks. Long story short, when you're looking at New York setups, you want to be looking at where you are relative to a discount or a premium for your entry, and then targeting areas of imbalance or liquidity below old lows or above old highs, or areas of inefficiency. That's all this is. Okay, IPTA will be seeking one of those two things: external range liquidity. Okay, and that's this, trading below old lows. That's external range liquidity. And internal range liquidity. Now I just threw you a curveball. I know. What makes this internal range and this external range? From this high to this low, we retraced inside of that. Below this range here, this is external range liquidity. That's what we're aiming for, or what I was aiming for today. From this high to this low here, because price is fractal, if we break down and trade below this, this outlined that the market will want to go here. This is internal range liquidity. It can just stop below here, go whipping through it, and never get down to this price point until a later time. And that's where there's a discrepancy amongst my students, where who is looking for what. That might be your model. You might be getting out here and be done with your trade. Others may say, okay, I'm going to take a portion off here, and I'm going to aim for this down here. Is either one better than the other? No, because you're all going to be thinking independently and uniquely your own model. But you're all going to have to work within the same context of what IPTA is being taught to you as. It's discounted premium, external range, internal range liquidity, and that's all you're doing. You're taking one form of liquidity, a premium, and you have a bias, it's going lower. You're looking to offset that with someone at a discount array, something that would offer an area of buying. Buyers are going to be down in here because they've trailed stop losses up. Whose stop losses down here? Large funds. Think. It's not all retail. Large funds. That's where liquidity is targeted. So hopefully you found what I've given you tonight insightful. I gave you a lot of stuff, folks. Listen to this video several different times, okay? And then come back to it next week, and in mid-April, come back to this one, because it's got some really, really good things in it. It's just one of these really nice lessons that I learned the importance of what I just gave you tonight by studying it and seeing many, many examples of it. But again, it's not made up, it's not contrived. You can see what I was doing now and understanding why I was doing it with my scales. Okay, I'm not just indiscriminately going in here and saying, well, I feel like I made enough money on this one. I'm getting antsy. Let me just take something off. I'm taking them off at logical price levels. And I'm watching them trade down to them. I'm doing it every single week. I'm not trying to teach you something that is not transferable in terms of an understanding or concept. These things repeat. They repeat all the time. But every setup is going to be slightly unique. You may not have volume imbalances. You may not have a void. You may not have a fair value gap. It may only be an efficiently delivered price range. If you have an efficiently delivered price range, and again, what do I mean by that in contrast? This is inefficient. Look how fast it is. Inefficiency is characterized by quick, fast displacement of price. That's this. This is all inefficient. An efficient delivery of price would be something like this, where it's back and forth, up and down, up and down, up and down, up and down over a longer time, grinding. And then it's a quick run, imbalance, rebalance, imbalance. rebalance, imbalance. Rebalance, imbalance is coming. So I've taught you where the imbalances begin, where they end, what's the purpose of understanding what to do with these imbalances. I taught you delimiters inside of those imbalances, which create areas of real support and resistance, because they're points at which the algorithm will seek in previous data. Once a imbalance is filled, it becomes a new range. That range is significant. This is what makes the understanding of support and resistance a fallacy. Because if you understand what I just taught you tonight, you'll be able to go in the price charts and find what the real support and resistance levels are, and you'll look like a wizard. So if you have an ideal scenario where you want to go and start doing analysis, to drum up extra money, say you don't have a lot of money and you've used all the money to go through the mentorship, that's fine. It's great. I didn't have much money when I started either. But you can do a service and just do like I'm doing. I mean, I don't get out here. None of you guys ever seen me trade a live account. Never done it. Okay? And I've made millions of dollars doing what you see me doing here. You all religiously follow me, and I'm loyally delivering content. I stick to what I teach. I teach more as I go, but my stuff works. You can open up an analysis service, okay, that gives your opinions about certain things and incorporate support and resistance. But your support and resistance will be the ones that work, and you will have an air of mystery around that, because I've just taught you how to use fair value. The imbalance and rebalancing of price allows you to pinpoint exactly what support and resistance levels are going to be significant right now. And if you incorporate that with time and price, you will look next level. And believe me, if you're not teaching it and you're just telling them this is the level you like, people are going to flock around you, and they're going to be just waiting every time you say something about a market or whatever it is that you're talking about. Your words are going to be commanding. If you say something, they're going to want to listen. If you type something, they're going to want to read it, because you have proven yourself to be able to show a prowess that no one else is efficiently and effectively doing as it relates to support and resistance. If you look at TradingView, or if you go on any other website, there's 1,000 different trend lines. There's 1,000 different support and resistance levels that you're all using. Diagonal this, horizontal that, and it's all nuts. But I just taught you how to go in and find the real support and resistance levels relative to imbalances and rebalancing, and how to find them, incorporate that also with order blocks, and suddenly now you have a complete depth of understanding of price that's completely outside of the normal realm of retail thinking. So I'll talk to you next time. Wish you good luck and good trading.